Welcome back to Real Estate Syndicated Live, episode 64. And as you guys can see, I have our first three-time returning guest, Mr. Jay Scott. You are our first. Super excited to have you, buddy. Welcome back from your trip. You just got back from an anniversary trip, right?
I did. Spent a week in Jamaica with my 15-year bride. Had a great trip, very relaxed, and ready to get back to work.
Love it, man. Love it. And it's going to be a little weird because usually we do this on our Drunk Real Estate podcast, and usually we're drinking. Usually one of us is hammered by now, and I won't say who. You can maybe tune into the show to see who's usually hammered by now. So it'll be a little bit of a weird interview. We're going to be sober, and I'll try not to argue with you this time because I'm always, my goal in that other podcast is to completely argue with whatever you say. I'm going to take the opposite position. But on this one, I'm going to let you have the limelight, my friend. Real quick, for those of you who don't know you, I love that you said the other day you're the Bigger Pockets OG, which I thought was a great intro. Tell everyone who does not know who you are, give them the 30-second version of what you do.
Yeah, engineer by education, spent most of my career in Silicon Valley in the tech industry. 2008, left and fell into real estate with my wife, and we flipped 400, 500 houses between 2008 and 2017, then fell into multifamily and have been doing multifamily syndication with my partner, Ashley Wilson, who you should know pretty well because you do all of our securities work, you and your firm. And
she, by the way, she's a two-time guest.
She should be the first three-time guest. She's much more worthy than I am. But yeah, written a few books and do a bunch of real estate and business stuff. And yeah, that's a little bit of everything.
Cool. And I should have probably apologized ahead of time. I'm obviously, as you can tell, on the road. I'm not in my usual amazing studio. So I think the audio is pretty crappy. Lighting is definitely crappy. It makes me look 20 years older and 20 pounds lighter. But anyway, let's get right to it, Jay. This is the episode on macroeconomics, which obviously is one of the important things for real estate syndicators. And even, if you're a commercial real estate investor, super, super important. So I'm going to start. I told you this, my friend. I know you hate this question, so I'm going to ask it right off the bat. But I'm going to do it in a fun way. Finish this sentence, Jay. The recession is going to happen blank.
Most definitely at some point. Yeah. So
Are we in one? Are we in one?
No. So the answer I keep giving is who cares? It doesn't matter. It's just a word. There's no formal definition. I don't like that successive quarters of negative GDP. I think that's a bad definition because we have exceptions to it and it just doesn't track. And so I kind of just blow off that question a lot. But after seeing a lot of the economic data that we've seen over the last couple weeks, last couple even months, I'm really kind of convinced right now that we are not in a recession. I'm not saying everything's great because everything is not great. And there are a lot of indicators that we likely will be in a recession in the next 6 to 12 months. But as of where we are today, I mean, you look at inflation. Inflation is back under control, right at 3%. It'll likely be under 2% in the next couple of weeks. Unemployment it's a mixed bag, but corporate employment is really strong. The unemployment number, that bottom line number is strong. Payrolls are strong. We actually have some real wage growth over the last couple months. Not great wage growth, but at least it's above inflation. So we have real wage growth. PPI numbers, which is basically the equivalent of inflation, but for manufacturers, they're saying that they're not spending ridiculous amounts of money on their materials these days anymore. Just a lot of good looking. And then GDP. Last week we had basically GDP, which is like the total output of the economy. They were expecting that the economy to have grown at like 2%, which is a nice, reasonable, healthy growth. We came in at 2.4%. So, I mean, all things considered, it's really hard to say that the economy in general is in a recession. That said, not everything is great. Like I said before, there's certainly a wealth gap, and there are a lot of people that are feeling strapped, especially with the inflation we've seen over the last couple of years, especially with the stagnation in wages over the last couple of years. The price of housing, if anybody is out there looking to buy a house or to move to a different house, rents are going through the roof. So I'm not saying everything's perfect. I'm not saying nobody's struggling. But if you look at the economy as a whole, it's real hard to argue that we're in a recession right now.
Yeah, and guys, if you have a question for Jay, please drop it in the chat, and we'll definitely get to it. You rattled off a couple of interesting metrics, and I'm going to rattle off a couple more because I just pulled this up. I'm sure you've heard this before, but the Fed, as we all know, has been increasing rates now since March of last year, March 17th, actually. And I went back and pulled up a couple of metrics from back in March of 2022. S&P was at 4,357. Today it's at 4,513. So it's actually a little bit higher than it was when we started this 500 or 525 basis point hike over the last 60 months. Unemployment rate back when they started raising rates, 3.5%. And today, as you mentioned, top line numbers 3.6. GDP, when we started, was at 25.2 trillion. Today, it's 26.8 trillion. Now, we've had a couple of negatives, and so, you can probably argue that's below trend, but it's certainly still going in the right direction. We're still growing over the last 16 months. And you mentioned single family housing, at least on the single family side. They're trying to get that stuff down, Jay, but it keeps going up. I guess my question for you is, has the Fed managed to kind of pull off this soft landing that everybody thought they couldn't pull off? Are they pulling off a miracle?
Well, again, if you look at the macro data, if you look at these kind of big ticket nationwide economic numbers that a lot of people like to look at, the media likes to look at, it's tempting to say, yeah, we're heading towards a soft landing. But then as I mentioned, and as you certainly know, there's also a lot of negatives in this economy, a lot of things that could potentially break. So we saw some banking issues. Banks in general are not in as good a place as they were a year or two ago. A lot of banks are holding bonds, like we realized with the SVB collapse earlier this year, which has hit their balance sheet. Banks in general are likely not to see nearly as much revenue and profit over the next couple of years simply because of interest rates. Think about it this way: if banks are being able to get your savings at 0%, basically they have to pay you 0% interest on your savings when you deposit money, and then they can go and put that into a super safe investment at 2 or 3%. They're going to make 2 or 3% on their money. But if they have to pay us 3 or 4% in savings, which is where we're headed, they're not going to find a safe investment where they can generate more than 3 or 4%. So I have a feeling bank profits are going to get hit pretty hard. Certainly there could be liquidity crunch. If you look at consumer debt levels are through the roof. We're about to see college loan forgiveness that's gone away, and repayment on loans is going to start again next month. So a lot of people who for the last several years have probably gotten used to not having to make that loan payment every month, they're going to have to start making that payment again. Corporate debt. Companies are having a lot of trouble borrowing at reasonable rates. A few years ago, they were borrowing at 4, 5, 6%. These days, they need to borrow at the same rates we are. They're borrowing at 7, 8, 9% or even higher for some companies. And so there are a lot of things out there that could break the economy. And what we've seen, if you look at the last however many recessions, we can go back to every recession for the last 30 years, and we could find some thing or some things that we didn't expect that kind of snuck up on us and caused a big break in the economy. I mean, back in 2008, nobody expected all the stuff that was going on with mortgage-backed securities. Yeah, we knew we were in a bubble with housing, but we didn't know all the lending stuff that was going on. 2001, nobody expected 9/11. Go back to like the late 80s, early 90s, we had the savings and loan crisis. Nobody knew about that until it hit. I mean, there's always some surprise that creeps up. And so what's that surprise going to be this time? Is there a surprise this time? We don't know. So I think it would be foolish to say that we're like destined for a soft landing and we're destined not to have a recession coming up. I think more likely than not, we're going to see a softening. We're going to see a natural progression towards a recessionary event. And then if there's some big surprise or big issue that pops up that kind of snowballs like we've seen in previous recessions, it could get bad.
Yeah, and I think at some point you and I were talking about that, you think maybe this event's going to be businesses, just in terms of, there's been a lot of stress for businesses. Obviously, their borrowing costs have gone through the roof, as you know, and you've talked about that actually extensively, that, a lot of these companies really are kind of zombie companies, right? They were able to survive because when they needed money, they can go to the market and borrow at whatever 3, 4, 5%, and now they can't do that. They can borrow it, who knows, or they can't borrow. So are you still in that camp where you think that it's the businesses that are going to crack first, and that's going to cause unemployment to go up because they're going to have to either lay off workers or cut back their hours? Is that sort of the most likely scenario? Obviously, we don't know. We're all kind of guessing, but is that still kind of at the top of your list?
Yeah, if I had to bet, I think businesses, and typically what we see is that businesses lead economic trends. So if businesses are struggling, we're going to see the economy and then consumers start to struggle later on. If businesses are faring well, then we're going to see the economy kind of trend upwards and consumers do well later on. So it's a leading indicator. And I think for anybody that's kind of paying attention, and I have some roots in the venture capital world and the tech world, and what we're seeing is that there are a lot of struggling companies out there. There's a lot of startups that raised money a year or two ago. They're probably 6 to 12 months away from running out of capital. And they aren't able to raise at this point. They're not able to bring in more capital. And so what's going to happen in the next 6 to 12 months? They're going to start doing layoffs. Hopefully they'll be able to raise some money, but if they can't, they may end up having to shut their doors. And this is fully 20% of the economy. I mean, 20% of businesses are venture-backed or investor-backed businesses. If they can't raise money, they're in a lot of trouble.
Yeah, and I got to, by the way, give you total props. I was re-listening to our last episode about I think it was exactly 6 months ago. So the idea is to bring you on every 6 months and kind of check in. But you talked about sort of the top 3 biggest risks you were seeing for, I think specifically multifamily, but maybe commercial in general. And I got to tell you, nailed all 3 of them. I mean, I think the first one was just obviously with interest rates back then, we're still creeping up. I think they were probably at 3 at that point. But obviously that you were predicting that was going to put a lot of pressure on a lot of these operators that were going to either result in cash calls for people or having to raise additional capital or just give it back to the bank. And that's kind of what's happening. So I got to give you props to that. You also talked about the rate caps, which is another huge issue that I think was just starting to develop back then. Now today everybody knows about it, but back then you literally, I think, if I remember correctly, you literally had to sort of re-up from 1 month to the next, and your premiums have gone through the roof. So you've been spot on that. And if you haven't watched that episode, I would encourage you to watch it. What do you think for the next 6 months when we meet again? What do you think are the top 3 risks if you're a commercial real estate investor or maybe a multifamily specifically?
So I still think rate caps are a big one. I think a lot of people are kind of hoping that they can just muddle through. And there was a lot of hope from a lot of people that by this time or within the next few months, we were going to start to see rate cuts. And rate cuts and lower volatility is going to lead to obviously lower interest payments. If you have a floating rate loan, it's going to lead to cheaper rate caps. If you have a rate cap that's expiring, if lower rates are likely to lead to lower cap rates, which means higher values. So I think there are a lot of people out there that over the last year or two, since we started raising rates, since the Fed started raising rates, have been hopeful that we would be in a situation where we'd be ready to start cutting by the end of 2023 or beginning of 2024. And they've kind of based their business plan around that hey, survive till, I mean, in the business world, we have the saying, survive till 25.
I've heard a lot of that's like the new slogan these days.
Yeah, and it's because a lot of people in the tech world think that that's probably when lending is going to open up again, or investing, venture capital is likely to open up again. But I think there are a lot of people in the commercial real estate space that were thinking survive till 24. And if you can survive that long, if you can avoid having to do a refinance or having to do a sale or having to re-up on your rate cap or whatever it is, you'll probably be rewarded from the government with lower interest rates by the time 2024 comes around. Right now, it doesn't look like that's happening in 2023. I mean, again, unless something breaks in the next couple months, the Fed has clearly signaled that they're not looking to start dropping rates this year. Will it happen at the beginning of next year? I think we've talked about this on our Drunk Real Estate show, and I still believe that beginning of 2024, there's a reasonable shot that we start to see a drop in interest rates. But I don't think it's going to be back down to 0 or 1 or 2% like a lot of people were hoping for. I think unless something really big breaks, we might see a modest reduction. And so I think there are a lot of people out there that aren't going to be able to push out the whatever issue they're facing that much further. So what do I think the big risks are? I think it's the same ones. I think interest rates eating into NOI is a big one. Rate caps is a big one. Coming up towards the end of loan terms and having to refinance, but values being down is a big one. So it's really just a question of what operators can do if they get into a bad situation. Can they do a capital call? Can they negotiate with their lenders? I mean, we talked about this on the Drunk Real Estate show. Basically, the feds have come out and said they want lenders to work with multifamily and commercial borrowers. They don't want these loans to be going into foreclosure, and they don't want these properties to be taken back by the banks. And so I think that gives us some cover. And I think we're going to see probably less pain than we would have had the feds not said that. But I still think there are some risks out there, especially if we don't see interest rates dropping as soon as we were originally planning.
Yeah, and here's my take, and you tell me whether you agree or not. But like to your point, it's one or the other. So either interest rates will naturally go down. First of all, that's what the Fed's kind of said they will do, and the market's kind of predicting that anyway. So either the rates will go down slightly, but not enough to significantly help people who are in trouble, or I believe the interest rates will come down significantly, but it's because there's some bad event. So the reason the interest rates are down is because of some, unemployment's up at 10%, or it's another sort of 07, 08 or COVID, like something catastrophic like that. Yeah, great interest rates. The Fed's going to have to pivot, go down, maybe all the way down to zero or somewhere close. But that's not a good thing. That's not like, oh yeah, great, we're down back to zero. If the Fed's down back to zero, we're in deep doo-doo.
Yeah, I think one of the interesting things that I'm keeping my eye on is obviously everybody's familiar, most people are probably familiar with the fact that office is in a really bad spot right now. We've got a lot of open office space because we still have a lot of work from home. A lot of office investors are starting to face much worse situations than multifamily or self-storage or other commercial folks. But what I think a lot of people don't realize is a lot of the larger institutional office investors and even some of the smaller institutional office investors, a lot of times the way they are getting their debt is by collateralizing other non-office assets. So a lot of these larger investors, these institutional investors, have a portfolio across asset classes, and they're doing things like using their multifamily or their self-storage to collateralize their office holdings. So basically, they're pledging these other assets to the bank as collateral. Oh. If we get into a really bad situation with office, some of these larger investors could find that to satisfy their debts to investors, that they are losing some assets outside of office. So we think of that as kind of being specific to office, but I think that can kind of bleed over into other commercial asset classes, and I think we could start seeing office investors losing properties, multifamily properties, self-storage, other types of commercial warehouse, industrial to the banks because they've collateralized their office debt with it.
And then that causes the banks to liquidate they're probably going to write that off anyway. A portion of it, they'll take a haircut, but certainly those will be repriced, and it'll reset the market, right?
Exactly.
All right. Okay, cool. Hey, if you guys, I have a bunch of questions for Jay, but I don't want to monopolize his time. So if you guys have specific questions, please drop in the chat. We'll get to them. I heard a great conversation that you were having, I think a couple of weeks ago on one of the Bigger Pockets podcasts on the market. And Kathy, I'm going to give props to Kathy because Kathy made a point, which, I know it's out there, but I hadn't really thought about it too much. But in terms of, interest rates, I think you guys were playing a game trying to figure out where interest rates were going to be, if they're going to be higher or lower. And everybody was kind of giving their opinion. And Kathy made a great point that, this market's been heavily manipulated by the Fed, obviously, over the last however many years. And one of the things, or one of the ways it's been manipulating isn't just with the Fed funds rate, but it's actually they've been buying and selling mortgage-backed securities. And at the end of the day, that's really ultimately, that's part of that supply and demand equation. So back, many, many years ago, they started artificially buying mortgage-backed securities, and therefore artificially, bidding up those prices, which caused interest rates to go down. Well, now they're either they're selling or they're just letting those roll off their balance sheet. So they're not renewing, which is causing the opposite effect, which means the prices are going down, which means there's upward pressure on the interest rate. So even if there's other factors that you may think that's going to cause interest rates to come down, that's only true if we were in a sort of a true free market and those forces were allowed to play out. But what's really happening is you can't ignore the fact that the Fed is interfering still on the opposite end now with mortgage-backed securities. I don't think you actually got a chance to respond to that if you thought that was a valid point or if you had a counterpoint to that, but I just thought it was a really interesting point.
Yeah, 100%. I think it's a very valid point. I mean, again, like you said, everybody thinks about the fact that the Fed manipulates interest rates to kind of control the economy, control inflation, control recessions and expansions. But the other thing that the Fed can do is they can control basically how much capital, how much cash is out there in the market, and they do that by buying up assets. So, like you said, they'll go out and let's say they want to flood the market with capital. They'll go out and they'll buy $1 trillion worth of mortgage-backed securities, which basically they get this illiquid asset on their balance sheet, and then they flood the market with $1 trillion. And so if you look at the Fed's balance sheet, I think it's somewhere $8 or $9 trillion worth of these illiquid assets on their balance sheet, which means the Fed has essentially flooded the market with $8 or $9 trillion. And more money in the economy means that we're going to have more robust economy, but we're going to have inflation and we're going to have all the issues that we've seen over the last couple of years. Well, if the Fed starts doing the opposite, instead of buying these illiquid assets and putting cash out there, if instead they sell off these assets and they pull the cash out of the economy, we see the opposite. We see a tightening. And that's what the Fed has said, at least up until recently, that they were going to continue to do. They're going to start selling off assets on their balance sheet, sell down their balance sheet. Nobody really knows exactly what the numbers are, but if you ask some of the best economists, what they'll say is something like a $2 trillion reduction in the Fed balance sheet is equivalent to about a quarter-point interest rate hike. So if you assume that there's about $8 trillion on the balance sheet, if the Fed were to kind of sell off everything on their balance sheet and pull all of that money out of the economy, it would be the equivalent of interest rates going to something like 6.5%, without interest rates going to 6.5%. So you don't actually see that number because people don't really pay attention to it. But everybody should keep in mind that in the background, the Fed is trying to sell off these assets, which is essentially doing the same as raising interest rates.
Yeah, and another input to that mortgage rate is obviously the 10-year Treasury, and that's been spiking a little bit over the last. Actually, that's kind of been trending up a little bit over the last several months now. But just recently, and when I say recently, I think it was today, we had a spike above. We're back above 4%. And what's been in the news, obviously, is that the Fitch credit agency has downgraded the U.S. in general, their debt market. From a AAA rating to a AA plus, I believe. Yep. And that kind of spiked the 10-year Treasury. I don't know if it was because of that, but it certainly was maybe a coincidence. Talk a little bit about that. Is that a big deal, or how big of a deal should we be worried about Fitch, which is, it's been, I think, 11 years since, or maybe, I think, 2011 was when it was downgraded before. That was S&P.
Yep.
Is that a big deal, or is it like, nobody really pays attention to that? It's a non-issue.
I don't think it's a big deal. I think it's a data point, and it made the news, it made headlines, because you don't expect that to generally happen. But between yesterday and today, I don't think there's really, I don't want to say nobody, because we saw Treasury yields go up, which means fewer people are buying U.S. debt. But I think for the most part, there aren't too many people out there that saw that they lowered that rating and are suddenly thinking, I'm no longer going to invest in the U.S. because it's not a good investment. It's not a safe investment. It's still the safest investment on the planet. And I think that at the end of the day, maybe it had a 24, 48, or 72-hour impact on Treasury yields. But I think it'll be forgotten about soon enough, with the exception of, who knows? I mean, we have a political cycle coming up over the next year. I could see both sides trying to use this as kind of political capital. Republicans basically saying, look what the Democrats did to the economy, it got downgraded, and the Democrats basically saying, well, when Fitch downgraded it, they said they did it because of the Republicans threatening to not fund the country after the latest debt ceiling arguments. So I can see both sides potentially trying to use it to their advantage over the next year. But at the end of the day, I don't think anybody's really going to believe that the U.S. is any less safe, or that there's any safer investment on the planet out there than U.S. Treasuries. Yeah,
not to mention the interest. I mean, one thing I think people forget, even in our little back and forth with our drunk real estate. I mean, the Treasury market's a global market. I think people forget about that. So, yes, the 10-year specifically, yes, it's affected a little bit by the Fed, but these are such a deep market, and it's a really a worldwide market. And if you're an international investor and you got money to allocate, where else are you going to put it? Number one, if you're a Japanese investor, what are you going to put in? You're going to buy some Japanese debt at what is it now? I guess they've let it rise a little bit to 0.5 or 0.5%, and maybe it'll go up to 1. Yep. But and the carry trade too, Jay. So a lot of people, like if you're in Japan, you can get debt. You can actually borrow debt at 0.5% or 1%, turn around and then put that into the U.S. market at whatever. Whether it's the Treasury, you're getting already a nice little spread, and if you put it in the stock market, then it's even higher. So it's definitely a global market. I got a question here from Vincent. Vincent asks, "How would you deploy?" Thanks, Vincent, for chiming in here. Appreciate it. How would you deploy $1 million in capital right now for maximum return, considering real estate niches, starting a fund, business roll-ups, etc.? All opportunities on the table. And I will remind Vincent and everybody else listening that Jay is definitely not a financial advisor. No. He does not play one on TV, but definitely interested in thoughts. If I gave you $1 million, Jay, and I'm not, what would you do with it?
Well, I know this is a bit pedantic, but I'm going to say it anyway. When you ask the question, how would I deploy it for max return? I mean, if you put it on 00 on the roulette wheel, you could 30 times your money in about 30 seconds. You're not going to get much better max return than that, but we all know that that's like about as high risk of an investment or gamble that you could possibly do.
Well, risk adjusted max return, Jay. Risk adjusted.
So, but it is a good reminder because I get this question a lot, like where should I be investing my money for maximum returns? And I think that's what everybody needs to be thinking about, is that when we talk about returns, especially these days, we're talking about what this concept of risk adjusted returns. So the best returns with the minimal amount of risk. And one of the things that we need to consider for these days, and I hate saying this because I'm a multifamily syndicator, I take investor money all the time, I invest in my own syndications, but the reality is if treasuries are paying 4%, and you can invest in something like multifamily for a 5 or 5.5% cap rate. Now that doesn't include like doing renovations and getting benefits in other places. But basically, if your choices are for cash flow, putting money in treasuries at 4% or putting money in commercial real estate at 5.5%, is that 1.5% delta really enough to compensate for the risk of being in real estate? And so I'm not saying the answer is no, but I'm saying that that's certainly a much more difficult question than it was 2 years ago when you were getting 0.5% from U.S. Treasuries and you were getting that same 4.5 or 5% from real estate. That was a 4% spread. Now you're down to about a 1.5% spread. And so it's a much harder question these days. Should I be investing in real estate or should I be investing in the stock market, where you might get 5.5, 6 or 7 or 8%, but you can get a pretty much a guaranteed return of 4% or even a little more by putting money into U.S. Treasury bonds. And so all I'm saying there is, and again, like you said, I'm not an investment advisor. I'm not providing any recommendations here, but I will say think hard about maybe sitting on some cash for a little while, because I have a feeling that over the next 3, 6, 9, maybe 12 months that we're going to have some clarity on where the market's headed. And it's either we're going to have that soft landing and things are going to take off again, or we're going to have some recessionary event, whether it be a small downturn or whether it be a big recessionary event. But I think in the next 3 to 6 to 9 months, we're going to have some more clarity, and that's going to help us kind of figure out where's the right place to be deploying our capital. So in that time period, I'd say just be safe. Be diversified. Nothing wrong with investing in the same things you were investing in a year or 2 or 5 ago, but diversify more, because we don't know where the cracks might emerge if we do see cracks in the economy.
Yeah, not a bad idea to just keep your dry powder in treasuries earning. It doesn't have to be in treasury. You can put it in a money market account these days. I think you're getting north of 5%. So you've got that. Make your wish list. Get your shopping list out. Write down everything you want to buy, because there's a good chance all that stuff might be on sale. Jay, the last time you said even though you wrote the book on flipping, you said that's probably the one time you shouldn't be flipping. Is that still true today, or are we gotten to the point now where you think maybe it's okay to get back into that world? Because I know that's your original world anyway.
Yeah, so I think it's definitely safer in my mind than it was 6 or 12 months ago. Simply because the one time you, like you said, the one time you don't want to be flipping houses is when values are trending down. Because let's say you on a typical deal, you're expecting a 10 to 20% profit margin. If values fall 5 to 10% in that time, you've basically cut your margin in half, and you want more safety. So I don't like flipping in situations where you think the market's likely to drop. I personally think the single family market is actually pretty stable right now. I'm not saying we're not going to see, especially in some markets where we saw big run-ups over the last couple of years. I think we may see some more softness over the next year or 2 or 3. But I think for the most part, we've bottomed down on real estate prices again, unless there's some big cracks that we haven't foreseen that causes a big issue. I think single family housing is probably going to stay flat for the next couple of years. And so you're not going to get that boost we've been getting over the last 15 years from values rising. But I think it's a lot safer than it was, in my mind, 6 or 12 months ago, when I thought we'd see a bigger decline in values.
Let's talk about that last point that you made, because I wanted to ask about that anyway on the multifamily market anyway. So we had a pretty significant drop of, I want to say 15, depending on the market, right? Depending on the market, some more, some less, but somewhere between 15 to even 25% drop. But that happened, I think, sort of the beginning of last year. That was like a period where it dropped, and then it's kind of stabilized at that point for basically the last 12 months, give or take. It sounds like you're in the camp that we're not at the bottom there. We're kind of close because of interest rates. I mean, you're obviously putting a lot of stock on the fact that we're kind of at the end of this. Even the Fed is saying we're kind of at the end of that cycle. What odds do you put on, or maybe not what odds? That's not a great question. I was going to say, what odds do you put on a further decline in multifamily? But talk a little bit about the multifamily over the next 6 to 12 months. Where do you see that? Where do you see that?
The problem in multifamily, and I think a lot of commercial right now, is price discovery. There's so little transaction volume. There's so few deals taking place that it's really hard to figure out what things are worth or not worth. A lot of times we talk about this thing in commercial called a cap rate, which is basically a multiplier. So a property generates a certain amount of income, and based on whatever that multiplier is for that market and that particular asset class and that type of property, you apply that multiplier to the income, and that's the value of the property. Right now, we don't know what that multiplier is in a lot of markets, just because we don't have enough sales and we don't have enough transactions taking place. And the problem is that it's a fine line between a multiplier of 20 and a multiplier of 25. And so a small movement in cap rates can change that multiplier a whole lot. And so I think it is possible that as we see more transaction volume over the next 6 months, 9 months, that we could see some more downward price adjustments. But like you said, we saw 15 to 25% reduction in values and increase in cap rates about a year ago. And for the most part, we haven't seen a lot of movement since that time. I mean, it all kind of happened all at once last summer. So I think that was the big move downward. And I think for the most part, we're probably near lows in the multifamily space. I'm comfortable to be looking and buying right now. But again, who knows what we don't know?
Yeah, and I'm surprised that the price discovery has taken so long, because usually what happens is as prices adjust, so you get suddenly a 20% drop in prices, sellers are like still thinking their properties are worth 20% more. That maybe they only think it's down 10%, and so you get that gap. But usually after 12 months, especially if the price hasn't really moved that much, the sellers get the message, right? That, hey, look, your property's gone down 20% and it's not coming back up. Interest rates are where they are. So I found it a little surprising that it's taken that long for sellers to kind of adjust. What do you think it's going to take? Is it just more time for the price discovery to happen, and sellers I'm really blaming the sellers here, the sellers to come to reality?
So in my experience, and I've talked to a lot of operators over the last year and a half, I don't think sellers are confused about where values are. I think sellers just don't like where values are. And right now they are making, they're basically gambling on the fact that the market will correct in their favor. Cap rates will go down, interest rates will go down, lending will loosen up. They're kind of gambling on the fact that the market will correct in their favor before they hit a situation where they either need to refinance, they need to buy a new rate cap, interest rates go so high that they get into trouble. So I think a lot of sellers are just sitting back and saying, okay, I don't need to sell in the next year or 2 or 3. So I'm just going to sit back and wait. And if I can get my wish price, that price that will make my investors whole and make me whole and get us the profit we wanted, sure, we'll sell. But otherwise, we're just going to sit back and wait. And buyers are doing the same thing. Buyers are not they're not chasing properties. They're basically sitting back and waiting for the market to correct in their favor. And they're waiting for banks to start taking back properties. And they're waiting for sellers to run into situations where they can't hold any longer. And that's not happening either. So I think it's just a waiting game on both sides.
Yeah, my thesis has always been that, again, it takes a little bit of time when interest rates adjust. There's a little bit of a lag effect of when when we've talking about lag quite a bit, right? Again, it's been, 16 months since the Fed started raising rates. We usually say 12 to 18 months.
Yep.
Well, we're getting to the end of that. But it takes time for, especially in the multifamily world, for these pressures of higher interest rates. At some point they've got to refinance or their loan starts maturing. I forget what the statistics were. You probably know better than I do how many loans were maturing in 2022, 2023, 2024, but there's a lot of them. Isn't that a risk for sellers? Because that could, this is kind of one of my theses, it could bring a next leg down if suddenly the market is flooded with all of which we've seen some already, some of these operators who just, bought at basically bought at the peak. They've gotten into trouble between cap rates, going down, and also the rate caps issues. Are you expecting some kind of a huge flux of properties coming online? And are you kind of salivating for that?
Yeah. So, this goes back to what I was saying earlier, that a lot of sellers are waiting and they were hoping that by the end of this year, beginning of next year, that they'd be rescued by the market. And so I think a lot of it depends on when that happens, if that happens. It's going to happen at some point. But yeah, if this goes another 12, 18, 24 months, there's going to be a lot of desperate sellers out there. And then it's going to boil down to the question of, are banks going to be willing to work with sellers in those situations where sellers, let's say they're coming up on a refinance and they go to their lender and they say, hey, extend my loan for a month, or not a month, a year. Because we all know the interest rate drop's coming. And at that point, I'll be able to refinance for a cheaper rate. And if banks say yes, well, there's not going to be a lot of incentive for sellers to sell. If banks start saying no, then we're going to run into a situation where, yeah, we could see a lot of inventory hitting the market. But I think banks learned their lesson back in 2008, and they don't want to be taking back a lot of property. And they will if they have to. And I think, like in the office space, we're going to see a lot of property taken back because extending loans isn't going to fix that situation. Increasing IO periods isn't going to fix that situation. Those properties are just too far gone. But in the multifamily space, for the most part, a lot of operators, a lot of deals are really healthy. And it's just this interest rate thing that's impacting it. And if banks can say, hey, we'll bail you out for 12, 18, 24 months. And then when everything's passed and we're back on track with interest rates, we'll deal with it then. I think a lot of banks may opt to just do that. And so I'm a lot less excited about all the deals that are going to be hitting the market than I was a year ago when this first started.
Yeah, I was at a conference the other, I think you were, I don't know if you were there or not, but we were talking about how the actual asset class itself of apartment, multifamily, NOI, rents, NOI, the actual business model. If you were buying these things for cash, you're doing great. The only issue has been, to your point, the interest rates has been crushing people, and but as an asset class itself, it's just the prices just need to come down to adjust for that, right?
Yeah, I do want to address. Mr. Ben Franklin made a comment here. He said, "Treasuries."
I was going to bring it up.
Treasuries are 4%, but core inflation is above that. It's about at that these days. Well, real inflation is probably much higher, but by government numbers, core inflation is about that. So it's not as good a trade as people are thinking. Just to address that, I'm a poker player. And so we have this
one.
I used to be a good one. We have this kind of philosophy in poker that it's not always about winning the most money. Sometimes you're in a situation where the goal is to lose the least amount of money. You go into a hand and you're in a hand where it's unlikely you're going to win. And you can do stupid stuff and make a big bluff and put all your money in hopes of winning a big pot. But a lot of times the right strategy is just to figure out how to lose the least amount of money. And I think where we are in the economic cycle right now, where things are just with so much uncertainty in the market, this is a good place for a lot of people to be thinking about how to not necessarily make the most money, but how to lose the least amount of money, or just make enough money that they can survive. And so this is a good example of, treasuries and inflation might be right around the same amount right now. Maybe inflation's a little bit higher than treasury rates. Real inflation's higher than treasury rates. But I would rather lose 1% or 2% over the next year or two on my money than make an investment where I lose 100% or 50%. So I'm not necessarily a big fan of that argument that you need to chase capital just because inflation is high. Sometimes just losing a little bit of money or losing as little as possible and licking your wounds and keeping dry powder for when things get better is the right move.
Yeah, and I would argue too that, especially, I mean, yes, you and I, for sure, it becomes attractive when Treasury's at 4% and our savings account is at whatever, still 0.5%. So it makes sense for me to start looking at, well, should I buy some Treasuries just so I at least get 4% versus 1% that I'm getting the bank? But the vast majority of the sort of the institutional players, especially the sovereign wealth fund players, they use treasuries a lot for other reasons other than the return, right? So they use it a lot for collateral, for example, when institutions trade back and forth or do overnight lending, or the repo market, which we're not going to get into in this one. They use pristine collateral, and right now pristine collateral is generally considered treasuries. It used to be mortgage-backed securities as well, but so a lot of people need the treasuries, aren't necessarily buying treasuries just for the return. In fact, I would argue they usually use it for either collateral or because they're either concerned about something, so they're looking for safety, and so they rush to safety, which drives interest rates down. Or if they think, hey, I've got some expectation of inflation and I think the stock market's going to go great, or there's other assets out there, then they'll sell their treasuries. So it's more of a parking your money vehicle, to your point. And there's nothing wrong with losing 1% of due to inflation versus, more if you go to other asset classes. So, which brings us to, it's amazing. We've already almost 45 minutes into this, and we haven't talked about yield curve inversion, which usually is the precursor to a recession. And I haven't checked the curves lately, Jay, but they keep, not only are they inverted, but they're massively inverted. I don't know if I don't think it's an all-time, but the 2 and the 10-year, I mean, it just literally makes no sense that, again, if you're just looking at the returns, right? Well, why would you buy, why would you accept a higher interest rate, at the lower end, or maybe better said, a lower interest rate at the longer end of the curve? It makes no sense from that perspective, but there are other reasons behind it. What's your current view on the curve inversion, which inverted quite a while ago? People will say, hey, dude, it's been inverted. You've been talking about this for 12, 18 months. Nothing's happened. What's your take on the yield curve inversion that we're still in?
Yeah, I mean, the first thing to remember is that yield curve is driven by sentiment, investor sentiment for the most part. And we see yield curve inversions, as you know, when investors are confused or concerned, they don't really know what's going on. I'm surprised that we've seen one this long and this dramatic. Don't really know what to make of that. But it at the end of the day, I think it boils down to, there are a lot of investors, large investors. And when we say large investors, we're talking about institutional investors and even governments that are buying enough treasuries that they can move markets. And I think a lot of them are concerned about where the economy is headed. And we talk about this ourselves. I think everybody is thinking, or at least most people are thinking, that we're heading towards a recession. I haven't talked to too many people. I mean, even if you think things are really good right now, and I'll argue that things are pretty good right now, I don't talk to too many people who think that we're going to go another 5 years without a recession. A lot of people think that we're probably 6 or 12 months from a recession, even if it's not a bad one. And I think that perception is pretty pervasive amongst large investors as well. Even though the stock market's doing pretty well short term, I think a lot of investors are kind of hedging their bets, and they're trying to figure out what's going to happen. And that hedging is what's leading these longer term securities, or leading investors to pull money out of these long term bonds and just kind of put them in the short term bonds, put them in for 3 months or 6 months or a year, just so we can see what happens before we start before we whatever happens. And so yeah. I think I said that backwards, actually. A lot of people are moving money out of the short term and they're putting it in the long term, because they're just fleeing to safety until they know what happens.
Yeah, and it's interesting if you look at the curve action of not the curve action, the 10-year yield over the last 6 to 12 months, it doesn't actually correlate with the Fed funds rate. In fact, the Fed funds been raising since it got to 4 to 5 to 5.25, and the 10-year was actually going down. So it's not a direct correlation. One thing I wanted to point out, and then maybe we'll wrap it up here, Jay, is that I find it really fascinating that if we were having this discussion a month ago or 2 months ago, everybody was talking about the recession's coming. It's here any minute now. Even Powell was saying we're probably going to have a recession. It's going to be mild, but we're going to have a recession. And then literally over the last, I would say, a month or maybe less, you've seen that sentiment starting to switch. And now I just keep seeing article after article after article about, hey, we're not expecting a recession now, or the recession's getting pushed out. And I always feel like that's the reason why the recession is going to happen, right? It's almost like that opposite trade. Like one of the reasons a lot of folks that I was following believe that there was not going to be a recession is because everybody thought there was a recession. When everybody thinks something's going to happen, generally it doesn't happen. So now I'm even more convinced that as people start getting more comfortable or saying, hey, we've avoided it, there's been a soft landing, way to go, Powell, that's when we're going to get hit. I don't know if you agree with that or not, but that's kind of my thought reading all these articles over the past couple of weeks.
Yeah, I agree. And I think that there's stuff lurking out there that could cause big issues. We don't know exactly what they are. Again, likely in the business space or in the consumer credit or debt space. And so, yeah, I don't think it would take much for us to have a major economic event, but it's not obvious what that is. And when it comes to consumer confidence, I mean, if you look at, there's basically two big surveys that are done every month that kind of judge consumer confidence. There's one called the Conference Board, which is a independent third party that's been measuring consumer confidence for the last, I don't know, many decades. And then the University of Michigan does a consumer confidence study once a month. And if you look at the results of both of those in July, I mean, consumer confidence just soared. So there are a lot of people out there who are thinking that, or when I say July, I mean leading up to July, so the last 2 or 3 months, a lot of people out there who seem to believe that the economy is in a much better position now than it was even just earlier this year. Obviously, that doesn't mean it is, but we both know that consumer confidence goes a long way towards actually driving the economy. When people think the economy is good, they act like it's good, they spend like it's good, they work like it's good, and that actually makes it better. And when they think the economy is bad, they spend like it's bad, and they work like it's bad, and they act like it's bad, and it makes it worse. And so I think just the fact that we're seeing good consumer confidence numbers over the last couple of months leads me to believe that at least for the next couple months, things will probably be pretty safe.
Yeah, well, our co-host over at Drunk Real Estate, Kyle Wilson, also known as Ashley Wilson's husband, that was kind of his point. I think he mentioned that where he was kind of not joking. I think people are going to realize they're going to, especially with the holidays, they're going to be like, the student loans payments have come back. They're just going to get to the holidays and start spending money and realize, crap, I don't have any money. And that's going to be kind of that cascade that starts. So I think he and I are on the same page. He's just expecting something to happen the first quarter of next year. But and again, let's plug the show a little bit, Jay. So you, me, AJ Osborne, the amazing AJ, and Kyle, we started our podcast, The Drunk Real Estate, which will get dropped this Friday. So if you haven't checked that out, I'd recommend you guys check that out. Jay, what are you up to today? These days, what are you looking at? How can people get a hold of you and follow your amazing work?
Yeah, so I am doing more of this. I get to spend my days talking to amazing people like you and do these fun podcasts focused on multifamily real estate. Anybody that wants to get in touch or find out more about me or whatever, just go to jscott.com, JSCOTT.com, and that'll link you out to everything. And yeah, like you said, let me plug Drunk Real Estate here. So once a week, Mauricio, myself, AJ Osborne, Kyle Wilson, The four of us sit down. We pick the top three generally newsworthy topics going on in the world that we think are important for real estate investors. And we sit there and we talk about them for an hour and a half in gory detail, and we argue and we drink and we argue some more. And so yeah, go
We
look
drink a
up
lot,
Conference.
especially Jay. Jay drinks a lot.
I have been drinking a lot.
All right, my friend. Hey, listen, I always appreciate your time. I know you're super, super busy, especially these days. So I really appreciate you coming and sharing with the real estate syndicated community. We will get this 6 months from now. We'll revisit this. I think by then we'll be in a recession. So I won't have to ask you that anymore because we'll know it that we'll be in a recession. But buddy, I really appreciate you guys. If you're still here, I'd appreciate if you guys could hit the like and subscribe button. And until then, we'll see you next Wednesday here at the Real Estate Syndicator Live. Thanks, Jay.
Thanks, everybody.